So welcome everybody, thanks for coming. The goal tonight is just to kind of run through the whole process of what it looks like to buy a house. We're going to go from like getting pre-approved all the way through till owning a house, right? And so we're going to try to give you hopefully as much detail but not too much detail so that you kind of know what to expect. So who are the people you're working with and what will they do? And then when's a good time to meet a lender? So I am super excited to be working with these guys. So Austin and I, we did this presentation 6 months ago?
Yeah, 6 months ago.
6 months ago, and at the end of this month, a couple that was sitting where you guys are sitting now are closing on their first home, and they will be homeowners. They literally just gave us the last documentation that we needed, and they'll be going into we're going to send out their loan documents next week. They're going to sign, put down their down payment, and they're going to own a house. So Austin has lived through this. I don't know if you've seen Tiffany. She's everywhere on social media. She's pretty amazing. She's an agent here as well. If you don't follow her, I'm going to send you guys some stuff at the end. Like I'll give her all of her. What's it called?
Tiffany Duran Realty.
Yeah,
on Instagram.
But it's called a handle.
A handle. Yeah.
We're going to give out the handles at the end of this,
We'll take care
which
of that.
I totally know about and I'm super informed about. So we're going to do the handles, but it's fun. She does a lot of educational, informative reels and things. We're going to talk about when you meet a lender, how much money you're going to need, as far as like what closing costs are, and also what are minimum down payment requirements. How do you find a home? We're going to talk about the process, exactly how long it takes. So a realtor's job basically is to find you a home. They're going to help you to write and negotiate. It's going to start off being an offer, and then it's going to end up being a contract between you and the seller. They're going to negotiate on your behalf. They're going to manage the process of like your home inspections and appraisals. And then what the loan officer does, that's me. Loan officer pre-approves you for the financing. So our job is to look at all your finances, make sure that you qualify, submit your paperwork to a bank, have the bank do the final underwriting and get you through that process. We also help you pick the rate. We talk about when it's a good time to lock, and then we just manage that approval process. So the lender also orders the appraisal. So we send out an appraiser because every loan needs an appraisal. Whenever you're buying a home, you need an appraisal. There are sometimes you get what's called an automated appraisal where you don't actually get an appraisal, but 95% of all homes need actual appraisals done. And that person is hired by, a lot of people ask, can we hire our own appraisal? It's a no, like you have to use the bank appraiser. We process and approve the loan. We provide you the loan documents and we fund the loan. So it's basically, I'd like to say it's our money, but it's really not my money at all. It's my company's money, and we send the funds. Escrow. So have you guys heard the term, we're in escrow? So escrow is title and escrow companies. There's about 3 main ones here in Monterey County. Chicago Title, First American Title, and Old Republic Title. Almost all of those are basically set up to be neutral third parties. That's why we say Switzerland. They're the people in between you and the seller. They guarantee the seller that the seller is going to get all their money before they release the ownership of the property. And on the buy side, they guarantee that once you give that money, the house is going to be put in your name. That's their job, and they are supposed to be neutral. They hold all the money, so like you're never giving money to your agents. You're never giving money to me. Like I don't touch any real money. I touch bank statements and things like that, but I don't touch money. Money goes straight into escrow, and then they give the money to the seller as well. And they basically follow directions on the contract. So when you guys are writing your contract and you're making an offer on a house, with your agents there, with your realtor, they're gonna write down instructions. We'll pay this much. We want the house to close on such and such date. We don't want it to close before such and such date. As you're filling that out, escrow is responsible for enforcing that on their side. Okay, players and professionals. So we live in Monterey County. The majority of the homes in Monterey County were built more than 2 years ago, more than 3 years ago. A lot of them were built in the 60s and 70s, and so we always recommend that you get a home inspection. And so what home inspectors do, they literally inspect the house. They go through and they tell you everything that's wrong with the house. I would say, and maybe I'm wrong about this, so I'll ask the realtors who are actually professionals in this. I would say that most home inspections have lots of things wrong with them. Is that accurate?
Well, they're paid to find problems and find them. Even very minor things, but they report everything. The detail is pretty crazy.
Yeah, so they'll report on structural issues. You can do what's called a pest inspection, where you can see if it has wood-destroying pests, and those are termites. Are there termites and are there bugs in the house? And if there are, they'll recommend getting that fixed. because we live in so close to the water and a pretty foresty area, most of the houses have some sort of termite issue.
Almost
right?
every house does.
Right.
Yeah.
And so those repairs cost anywhere from, what would you say, 1,000 to 10,000?
Typically, I
Yeah.
saw one the other day for 29, but
Big house,
not even that big. Just
deck.
deck.
That's what it is.
Yeah.
It's always the decks.
$18,000 deck.
They look so pretty. They look so pretty, but they
Yeah.
look pretty to bugs too. So that's the issue. You can have septic inspections if you have if some of the houses in like on 68 and in Carmel Valley, they're on septic. They're not on public water, and so you have to get those inspected. All inspections are optional. Realtors are going to typically tell you to get the inspections that they think are pertinent. I would say that most, if not all, houses get home inspections. Is that
Nowadays,
Yeah.
8 months ago, when in the height of things, people were dropping physical contingencies. They're like, just get me into the house. People are, I mean, I haven't personally dealt with this, but I've heard, that some people are really regretting that now because it was just so competitive to get into a home. They're just like, we'll just take it. We don't need a home inspection. And
now because they didn't have an inspection, they're
then
finding
they
stuff out,
realize there's $100,000 of foundation damage.
right?
Yeah.
So they're trying to avoid that. So we're going to recommend that you get all your inspections, that you look at the house really
Yeah.
thoroughly before you buy
Definitely.
it, and you make sure it's the one.
This is probably a good time to bring up that since you all have come here today,
Mm-hmm.
that Better Homes and Gardens will be paying for your home inspection at the close of escrow if you decide to purchase with us. So, which is typically around a $700 value, $700 value, right around there. So,
Awesome. No, that's very cool. It's good to know what you're buying, right? So the appraiser, that's one that we hire. So we hire it through a pool of appraisers. When you're in contract, we'll order an appraisal. The appraiser goes out and they determine the value based on recent comparable sales, and square footage is usually what they look at. So it's very, people are always, when people are selling their house or people getting their house refinanced, are always like, do I need to clean it up? I'm like, it's not going to make a difference if you clean it up or not. It's literally square footage and comparable sales. Like, they don't care that you have kids. They don't care. So far and away, the reason that most people hesitate to buy a home or have trouble buying a home or don't qualify buying a home is credit. So we're going to go over credit scores just briefly. We're going to talk about what a credit score is, why it's important, and then what determines the score. So this is the formula for credit. So what we look at, what we see the most of is, first and foremost, well, we have teachers here. It's like, credit's like a report card, except they don't care so much about what you did in like first grade. They care more what you did like last semester, right? So what we look at is payment history, and as long as you have a good payment history for the last 24 months, you're usually okay. If you have a perfect credit history forever, that's fantastic, but not everyone does. So you can't really change credit history. Utilization is an important one to think about. So when you have credit card balances, when you have credit cards, you always want to keep your, and this is a weird thing that doesn't make a whole lot of sense, but is true. You always want to keep your balance under 20% of what's available. So if you have a $4,000 card, you don't want to spend more than $1,000 on that card. If you're at 50%, it's negative, and if you're at 75%, it's more negative, and if you're at like 100%, like if you max out your credit card, your credit score drops dramatically, right? So if you keep everything under 20%, you're going to get the best credit score. You're going to get the best result from that credit. Another thing they look at is the length of credit history, because we're looking at risk, right? So banks are looking at risk and trying to figure out, is this a good risk? So they look at how long you've been borrowing money, and then we have a better, more clear understanding of your ability to pay or your ability to manage your debts. And then new credit. I think one of the things that people always say, which is true, is don't get new credit when you're getting ready to buy a house. So don't go out and get a new car or credit cards or anything else when you're starting when you're looking to purchase, because it affects 10%. So getting a new car right before you buy a house could literally lower your credit score. The reason that's important is the higher your credit score, the better your credit score, the better interest rate you're going to get. Right? So if you are above 740, you actually sometimes will get discounts on the interest rate. If you're below 680, you start to actually have penalties, right? So the rates are higher and they're more expensive, which is something you can do well to avoid. It's a good idea if you're thinking about buying a home, getting pre-approved even if you're not buying for 6 months or a year from now, it's a good idea to get your credit pulled because oftentimes things show up that you're not expecting. The most common is like a medical collection because I was working over here and I thought insurance was going to cover it, but then I left that job or I moved and now they sent the bill to the old place and all of a sudden you have a collection that you never knew about, but you can't buy the house until that's all fixed. So whenever we do a pre-approval, we're going to run your credit report. We're going to take a look at it. Certain loans require only a 620 credit score. That's FHA and VA. There's also USDA is up there. USDA is U.S. Department of Agriculture, and if you'd like to buy a home in a very rural area, we can do U.S. Department of Agriculture loan. There's like hardly any places in Monterey County that qualify. FHA and VA are very common loans for first-time buyers. A 640 is the minimum required for a conventional loan. Now, conventional loan is what most people get. That's a 30-year fix. Typically, it's Fannie Mae or Freddie Mac. Those are just the most common loans. When people say what type of loan is it, it's usually a conventional loan. Things that will show up on your credit report that's an issue is if you have like disputed accounts. I don't know if you usually don't know about a disputed account until you've had one. So like we see this a lot with cell phone companies, right? So like the cell phone company wanted to charge me when I canceled it and then they sent it to collections and I'm disputing that it happened. So because there's a dispute on there, that dispute needs to get resolved or else you can't move forward with buying the house, right? So there's things to look at. And these are things that people honestly forget about. You got mad, you called the credit bureau and said, I'm not paying Verizon, whatever. I don't know why it's always Verizon in my head. I think I might have an issue with Verizon.
You're not the only one.
Yeah, see? So I'm not paying them, and then you just forget about it. And then 5 years later, you go to buy a house, and you're like, I've got a good job now, I've got money down, this is going to be great. And it's not great because you forgot to fix it with Verizon. So that's another reason to pull credit sooner. Credit will also see any judgments or liens. So if you have, the most common one is child support. If you have alimony that's being paid, they will see it on the credit report. And we just need, at that point, we're going to be prompted to ask you if we can get a copy of the support orders, if we can get a copy of the alimony so that we can make sure that we're getting everything right. It'll say if you've had a bankruptcy, if you had a short sale or foreclosure, and then we can start a credit repair plan. I will tell you that 90% of all credit issues can be resolved in like 6 months or less if you see them ahead of time, right? Like if you know ahead of time, a lot of times it's things like I need to pay down the balance on my credit card. I need to call these people and tell them to remove this because it's not mine. That's actually my dad's name and my name, but that's his credit, not my credit, and you can get that repaired. And that happens a lot if you have similar names to family members. Okay, so credit. So once we pulled your credit, the down payment is required, and so both credit and the down payment are really what we use to kind of decide which loan you're going to be in. So an FHA loan can be as little as 3.5% down. So 3.5% down, those loans go up to about $850,000 this year. Next year they're going to go a little bit higher. So what that means is you can literally buy an $850,000 house with 3.5% down. Am I doing the math right in my head? 3 times 8 is 24. Half of that would be 4. So so for 30,000-ish, it's less than 30,000. I'm not doing the math right, but I'm good at rounding. So for $30,000 down, you could literally be in an $850,000 house today. VA loans require 0 down payment, but they do require like 6 years of military service. So if you're not in the military, let's just not talk about this. Conventional loans require 3 to 5% down, but that 3% is misleading. And the reason it is so it's true that you can do a conventional loan with 3% down. However, you have to qualify based on an income limit. Like you can't make more than the median income in the county. The problem with that is if you make just the median income in the county, you probably don't qualify for the homes that are for sale in our county, right? There's just not a lot of options there. So most of the time for conventional, think 5% down. People think I need money for a down payment. A lot of people think you need 20% down. That's never true. Well, I mean, it's not true most of the time. So traditional sources are savings accounts. A lot of people have 401k set up. I would say once a month we have a client who uses a 401k loan or a 403b or deferred comp, depending on which company you're working for. They use that for their down payment. They borrow against it. When you borrow against a 401k or you borrow against a 403b or any type of investment, as long as you have the money in the account to pay the total amount back, which means like you borrowed less than 50% or less, then we don't count that debt against you because we're saying you're borrowing it from yourself, and so you can decide if you want to pay yourself back. So it doesn't affect your debt at all. The other thing that's super common is gift funds. In fact, that's a question I ask most people all the time. Do you have anybody who's gifting you money? For the most part, that's super easy to document. It's a copy of a cashier's check and a letter from the giftor to the giftee saying, this is a gift and you don't have to pay it back and you're buying a house with it. Some things to know about gifts. You can go sideways, up or down, meaning you can have siblings, you can get gifts from parents, you can get gifts from grandparents, you can get gifts from children. I've only seen that a few times, but they have to be family. Like it has to be a close family or a close relative. In some cases, like a fiance works, or like a longtime partner will work, but we have to be able to prove that you've been there for a long time. Uncle works, yeah, relatives. And so the documentation for FHA is a little stricter, and this is where most parents get super annoyed with me, is they want to give their kid money and they don't understand why I have to see a copy of their bank account, and they get really upset with me. And I say that this is the federal regulation and that's what we have to do. And they say, well, I don't understand why you need that. And then I say, well, if you don't do it, they're not going to get their house. And then typically dad and mom cooperate. So how the lender sees your down payment. One of the most annoying things when buying a house is that we want to know where all the money came from. So like if you close an account and you transfer it, we need to see a copy of that final closing, the account statement where it's closed, and we need to see it transferred. The reason is the Patriot Act. Like we have to verify where all funds come from because we are working with finances and we're a financial institution. And this is every bank that you work with is going to ask you to verify and source where all the money came from. So we look at large deposits. You want to be careful because the one thing that we hate more than anything is cash. Cash is not documentable. You can't tell where cash came from. And people say, well, that's not true. My friend gave it to me. I'm like, yeah, but I can't verify that your friend gave you that cash by looking at a deposit. And so because I can't verify cash, we typically can't use cash. So if we can't use it, then those funds are not eligible, and it can be a reason why the loan doesn't go through. So if you're going to get cash deposits, you want to season that. And what that means is you want to have it in the bank 2 months before. So we need to not see a large deposit on the bank account. So the rule is if that money has been in your account, if we don't see a large deposit and that money was deposited prior to you going into contract, we're fine. But we're going to ask for the most recent 2 statements. So as long as it's made 90 days ago, we don't care where that money came from. When I say we, it's the lending world. Like this is the all-inclusive we. It's not like us three, just to be clear. So all deposits typically need to be sourced. Anytime there's money coming in that's not a paycheck where it says this is a, like a direct deposit payroll, anytime there's a large deposit, we need to know where it came from. So this is that 2-month rule I just talked about. 401k loans we just talked about. We're going to ask you for, if you borrow money from a 401k, we're going to ask you for terms of the loan. I can tell you that 99% of the time, most 401k companies just send you the terms with the check, right? So I'm borrowing $30,000 from my 401k, you get a cashier's check, and then on the top of it, like the stub basically says, this is a 401k loan, this is how, and so it literally usually you just scan it and send it in. Those are usually the terms. So this is for FHA, this is proof of having the funds to give, so that's why we asked the donor to see a copy of their bank statement. We need to show that grandma really had the $10,000 that she gave you. And then we need to see proof of how the money got from grandma to you. And that's usually proof of transfer is either a cashier's check or a wire transfer. Okay, an important term is debt to income ratio. So calculating your debt to income ratio, that's the existing monthly payments plus your projected new house payment divided by your gross monthly income. That's important to remember, it's gross monthly income. So I've always found that to be kind of scary because we're not looking at your net income. We're not looking at the money you actually touch, right? We're looking at your money before taxes. So let's say you're making $5,000 a month. Well, you don't really touch $5,000 a month if you're making $5,000 a month. If you're putting away to a 401k and you've got insurance and all of the other deductions, you touch about 4,200 of it, right? But we're still qualifying you on the 5,000. So that's just the way the numbers work. When we're doing the pre-approval, we look at your gross monthly income, we look at your monthly debts because we've got your credit report, so we know what all your monthly debts are, and then we divide the gross monthly by the new house payment plus any extra debt, and we get what's called your debt to income. Debt to income ratios need to be, for most loans, around 45 to 50% of your gross monthly income. But it's a scary number if you think about how much of your gross you get, right? So like That's your before taxes money, but you live on your after taxes money. So a lot of times what's going to happen is you're going to get pre-approved for a number that's bigger than what you want to spend. Like, congratulations, we're going to qualify you for that house. Here's a $7,000 payment. And you're like, I don't want to pay $7,000 a month, but we think you can. So you just have to be cautious. So how do we document income? How does a lender see your income? For most jobs, pay stub, W-2 jobs, we're going to ask you for W-2s for 2 years. We're going to check and see if you have bonus or commission income. If you have commission income, it's a 2-year wait. You need to have a 2-year history of having commission income. If it's a salary, we can use a salary income right away. And if it's hourly, then we need to have proof that either you're full-time or that you've been full-time, and we'll look at the last 2 years and average out that income. Overtime is the same thing. A lot of jobs like hospitals, police officers, they live on overtime, right? And so because they live on overtime, we need to see a 2-year history of showing that that is a real consistent number. Same for self-employment. If you're a server, cash tips cannot be counted. You didn't get a house.
Cash tips, even if it's all reported?
If it's reported, then it's okay because then it'll show up, right?
Yeah.
But
You want to report those if you're thinking about.
yeah. It's difficult, and employers, especially in the restaurant industry, really try to do a good job of like limiting their employees' exposure, and so a lot of times they don't show all of the cash tips. They do it to benefit so that their employees will have to pay less taxes, but then which is great for every time except for when you're buying a house. I'm always, as a loan officer, I'm always a proponent of paying more taxes because then you can qualify for more house. No one ever likes that. Self-employed is the same thing. We look at a 2-year history. So everything is a 2-year history. Anything below a 2-year history is an exception. Depending on what type of business, there are people that own multiple corporations, and if they own more than 25%, then we need to see those corporation returns.
So why work with a buyer's agent? A lot of people will go straight to the listing agent whenever they see a home that they're interested in, but the listing agent really just thinks about the person who's selling the house. So if you get your own buyer's agent, they're going to represent you and they're going to try to get the lowest cost for that house that they can get. And another thing is the selling agent is really going to focus on selling that one house, where a buyer's agent has keys to all the other properties that are on the market for you. We're going to negotiate the lowest cost for the house and see. So creating a game plan for the ideal home for you is really key to the whole thing. What a lot of agents do is they'll go out there, they'll start looking at homes with clients right away. What we do here at Better Homes and Gardens is we take time to get to know you better. We have you come in the office or go out for like a cup of coffee, and we'll just go over all the details of everything that you're looking for. And this will help us work for you so much better in the long run.
So Tiffany, you guys, I've seen this. I've seen the Better Home and Garden folks. You guys are on tour like 3 days a week, right?
Yeah.
And so there's literally a broker tour. So anytime a house is listed in Monterey County, these guys are out looking at the house, right? So if they've got a spec sheet for you guys, they'll actually do all that work for you and then tell you, hey, this is one that we think you might like based on the criteria that we've set up, right?
Yeah, before it even hits the market. So once we get a good game plan set for us, that's whenever we can start looking for properties. The MLS is a website that only realtors have access to. It has the most up-to-date information, and it also has the most accurate information. You will get access to off-market listings, and those are listings that aren't on Zillow or Redfin. So they won't be on any public websites. And if you register on our website, this is going to also have the same information that the MLS has because it's automatically updated from the MLS. And it's also a really good communication tool for us to work with you. If you like a property, it'll send us a notification, and you can also request a showing right then and there with one of us.
Now, after you go on your tour and you find a home you love, that's when we sit down and all the fun stuff starts to happen. So we write a contract. Basically, a real estate offer is a legally binding negotiated sales contract with its own terms, expiration dates. It's all submitted to the listing agent, and that's basically what is your offer. Now, a lot of the times, you can put an offer together when you think it looks great, but it doesn't really work with what the seller needs. And that's why a seasoned buyer's agent is so critical, because they're on the phone with the listing agent to say, hey, what works best for your client? Do they need to get rid of this house as fast as possible? Do they need a couple month rent back? Do they need to find another home? So that's also, sometimes you'll get into a counter offer situation. So say we say, all right, we give you this offer for this home, we'll close in 30 days. and they say, hey, we like your offer, but 30 days is too short. We are going to counter offer you. We want 60 days. That's the counter offer. Now you can accept it or renegotiate. So once the offer is accepted, you have 3 business days to get in what's called an earnest money deposit. That's kind of a sign of good faith. It's typically around 3% of the total offer value. And that money is refundable while your contingencies are in place. And contingencies is something that you actually build into the contract to protect you. It can get a little bit convoluted if I try to explain all that here. That's really a good opportunity to explain that at, say, one of our, as Tiffany was saying, when we sit down and have a little chat and a strategy session about it. It's a good time to go into detail there. Close of escrow dates, as I was saying, very negotiable. Typically, its standard is about 30 days. A lot of people like them quicker. Some people want more time.
Awesome. You said the EMD is, when's that normally due on a contract? Is that like
3 business days.
3 business days? Okay,
So,
just be clear on that, guys, because if you're like, I'm going to use, I was talking to Jeff, and Jeff said I could take money out of my 401k. That's totally true, but it takes 7 to 10 days to get money from most 401ks, right? So
Yeah.
you want to make sure that you have 3% liquid when you're getting ready to write
Right.
offers, right? Like ready to write because you need
Yeah.
to, the offer is going to get written on Saturday. Maybe it gets accepted on Monday. You need to have that money in the bank by Wednesday. Like, so just be aware that yes, you can use another source
Yeah.
and you can get a gift for a down payment, but like you still need 3%, somewhere between 1 and 3% liquid so that you can do it.
Yeah, exactly. So, yeah, it's 3 business days. The date of acceptance is day 0. Then the next day is day 1. So if you get into contract on a Friday, actually that money's not due till a Wednesday because it's Monday, Tuesday, Wednesday is your day 3. And as Jeff said, yeah, you want to make sure you at least have your earnest money deposit ready to go, which eventually rolls and becomes part of your down payment. So it's not extra money on top. Now, number 1 thing, let's determine the offer price. It's typically the most important thing to the seller is kind of what's their take home going to be. We like to stress, and I'm sure Jeff does too, is say you qualify for $850. Does that mean you spend all $850 that you're qualified for? Probably not. You're probably stretching a little thin because, you know, your debt to income ratio is your pre-tax dollars. It's a little bit different when you count all your expenses. And you also want to find out, what is this home worth to you? Say they want $850 for the house. Is it worth $850? What do the comparable properties show? Is it worth $850 to you? Now, the terms of the offer as well, there's all these other terms like loan terms. How much of a down payment are you going to put down? How long do you need to have your contingency, a loan contingency, so to speak, to protect you to make sure that the loan is going to be financed? And time frames as well for your other contingencies and close of escrow. Now, seller concessions is another topic where once you're in escrow with the seller, you do your inspections, you find some issues with the property. You can say, hey, you know, I really like this house, but we found out it had all this electrical problem with it, and you didn't tell me about that. Well, we want you to credit us, you know, $5,000 to do the repairs necessary. So you can renegotiate those numbers even after in contract for a set amount. So that's why you want to experience buyer's agent negotiator. And writing offers is free. So what I always like to stress to my clients, because I've experienced this before they get into contract, they want to pull city reports, all this other information, and then they go, well, you know, I don't really want it now. I'm like, what was I doing down at City Hall, you know, for half the day? It's most important to get the home that you're interested into contract, and then you can do the legwork. And then you're not competing against everybody else who can offer on it. You're literally only negotiating with the seller. So if it's a home you like, if it's a price you want, I always recommend just get it into contract first, and then you can negotiate. And we can write as many offers as you want. They're always free. So then the clock starts ticking.
All right, that's me. Okay, so you found the house, you went out, you looked at, how many houses do you think you look at before you end up buying? What do you think? What's a good average, Austin? Like 6, 10?
Yeah, probably around there.
Yeah, so you go out.
Sometimes 30.
Yeah,
Sometimes 1.
I was going to say 15, 20.
right. Well, and sometimes you write offers and they don't get accepted.
Yeah.
So you finally get the one and you've made an offer. Now on that contract, you've made an offer that's typically 30 days. That's the standard time frame. And so you get a date of when your escrow is going to close. If you're working with Better Homes and Garden, they have an excellent transaction coordinator who sends you this calendar that this is when things are going to happen. And so you know exactly when you're going to close. And so we kind of get re-engaged at that point. This is where like you go back and you go, okay, so I was pre-approved, I went out shopping, Austin found me the house. Where are rates today, Jeff? And if it's like the last couple of months, I say they're a little higher today than they were last week, right? But we'll kind of go over numbers, we'll look at everything, and we'll send you out disclosures. We're going to ask you for updated pay stubs. We're going to ask you for, depending on how long it's been, we might ask you for another tax return if it's been a long time. We're going to make sure that we have the most current information in, the most current bank statements. We're going to look at all of the applicable stuff, like did you have if you had a bankruptcy, we want to see the bankruptcy discharged. If you had a divorce, we want to see all that information as well. We're going to send these disclosures to you. We're going to ask you to sign those. Those are 99% of the time electronically disclosed. You're going to click and sign a plethora of documents. And then at that point, we're going to talk about when's a good time to lock in a rate, and we're going to lock in your interest rate. Typically, interest rates are locked for 30, 45, or 60 days. Once they're locked in, you know for sure that that rate's not going to change, and that will be the rate that you're going to have for as long as you keep your next loan. I would say 30 years, but 99% of the loans don't make it 30 years. Like most loans close, most loans are paid off or refinanced in an average of 4 to 8 years. We order the appraisal at that point. The last 2 or 3 years, appraisals were taking 3 weeks, 4 weeks, 6 weeks because so many people were buying homes. We had an appraisal ordered on Monday that came back on Wednesday. So it just depends on the volume, right? So there's not as many loans going right now, so appraisals will typically be back in 5 to 7 business days. 99% of the time that's paid up front. We actually at Cross Country don't do that. We just invoice it. We don't want to, what we found is it's easier just to order the appraisal and ask you guys to pay for it at closing than it is to track you down for a credit card, because typically when you go into contract, you've got more to worry about than giving me your credit card. So we just order it and invoice it. And again, they get values based on current condition and recent comparable sales. Your appraisal is either going to come back as is or it's going to come back subject to. What subject to means is the appraiser says, hey, this house looks like it's worth $700,000, and I think it would be if it didn't have this gaping hole in the wall. So this is subject to you repairing this gaping hole in the wall. I'll come back out and I'll re-inspect it. Most appraisals come back as is. Most realtors and listing agents who are selling homes know what it takes to get an appraisal cleared. We look at value differentials, so it can either come in higher. If it comes in higher, that's awesome. It's our little secret. We're not telling the seller. And the reason we're not telling the seller is because you're paying for that appraisal, it's your property, and I can't disclose your property. So if it comes in higher, that's great. If it comes in lower, well, that's typically when your buyer's agent goes back in and starts to talk about renegotiation, right? Like, hey guys, we were totally happy offering $700 for this house, but now it's like the appraisal came in at $680. The borrowers can't make that happen. Can we lower the price to $680? Depending on the strength of the market, you usually have a better chance of getting that through or not getting it through. When we do this, as soon as you go into contract, all your inspections start to take place. So if you have lots of inspections, like home inspections, pest inspections, septic inspections, all the other inspections, those all need to get scheduled. Again, we recommend you get the home inspected as much as possible, just because it's an insurance policy, because you want to know for sure what you're getting. Because for most of us, buying our home is the most expensive investment we're ever going to make. That's most clients. Appraisal. So you have an opportunity when big concerns come up on an appraisal. That is also an opportunity for you to say, look, if this appraisal came in low, I don't like it, or the appraiser found XYZ. Most of the time, appraisers don't find it, but the inspectors do. So that's the caveat, is you can have as many inspections as you want, but you have to be willing to pay for all of them, right? So, and also your agents will advise on that as well. Some inspections don't really help, right? Like a chimney inspection. Anyway, there's some that just don't really do much. Okay, so then we send the file in, and then we have to get your information reapproved. So all of your income and your asset information, is it all still okay? As long as it is, we're good. And then the appraisal gets inspected as well to make sure that it's up to code. Once we know that you have all the guidelines, we issue an approval, and then that approval is going to be what's called a conditional approval. So there's going to be prior to doc conditions, meaning before we send out the loan docs, we need to know X. What we need to know is like a lot of times, is that you're still employed. So this happened today. We had a client who was working, they were employed by the Social Security Administration, and we needed to call in and get a verification of employment, but the Social Security Department has a very strict rule that we do not verify employment over the phone. So like we were playing chicken with Social Security today. We're like, if you don't do that. Times of the essence is something you hear a lot. In order to have your loan moving at a reasonable pace, you need to get conditions back in 24 to 48 hours. So if you're being asked for, you need an updated pay stub, we need that updated pay stub as soon as possible, because it's not just as soon as you send it to us, we have to send it to someone else who's then going to review it and then either clear it or ask us for more information. And so you want that done as soon as possible. We try to have our prior to doc, so when we send a file in for the final inspection, it takes a day. So it's about 24 hours. If there's a lot of conditions, if a lot of things have changed, if you get a really tough approval, it can be up to like 48 hours. We take a final look at it, we make sure that you're ready to close, and then we order the loan documents. So that's going to be a thick packet of paper. That's going to be a note and a deed. That's going to say what your final rate is. It's going to have all of your information on it. There's going to be a ton of disclosures. It's about a 45 to an hour signing, 45 minute to an hour signing once the documents arrive. If you want to make it really fun, you can have one of the parties sign as a power of attorney, because that's super awesome. Because then you have to sign every document 4 times, which is way more fun than signing it 1 time. All parties typically need to be available unless you have a power of attorney. And then escrow will give you at that point your final number. They'll say, we need a wire of this much to close your loan. They set up a signing appointment. So we went through a lot of information very quickly. Something you're going to say, so when a deal is final, they say you're on record. And what we mean by that is it's been publicly recorded, that you're the owner of the property, right? It gets recorded at the county. And at that point, when we know that you're on record, these guys will come back and give you your keys. So we try to implement a client for life idea that we stay in touch. We continue to talk to clients, but after that, you are a homeowner. This is all of our Instagram stuff.